Hi, this is Wayne Delisle. In this article we're going to talk about how smart business owners reduce their tax bill. Look, I've been doing taxes for over 30 years, all right? Preparing tax, and mainly business owners. And one thing I've learned, and one thing I can't stress to you, is that I can have two businesses with the same sales, the same expenses, and business owner letter A, the first business owner is going to pay substantially less than the second business owner. And I call this one the smart business owner, and this one is the, well, we won't go down what we talk about. We're going to say basically the one that doesn't understand that that income tax is like any other expense that you have as a business owner. It is not my job as a CPA to control it. Yes, it is. I assist you. But it's your job as a business owner to treat it like every other expense and manage it. This means what you need to do is treat it like the rent. You don't just walk out there and say, real estate agent, go get me a property, and then sign the papers because you trust the real estate agent. You actually look at the document. You figure out whether you can afford the rent. Same thing. Taxes are the same thing. Though, what does the smart business owner do as opposed to the other business owner? Well, he plans and he manages it. He doesn't just turn it over. All right. So let's talk about that. That's the first step. Then, smart business owners take tax planning seriously. Look, tax planning is one of the few things that's guaranteed to save a business owner money. I'm from now until year end going to be working doing anywhere from 30 to 40 different tax plans for people, and every single one of them they pay less than what they would have paid if they had it. At a bare minimum, they know now what they're going to owe next March, April, or October if they take an extension. Now, most business owners, if I tell them they're going to owe $20,000 and I tell them in November that they're going to owe $20,000 in April, I'm giving them 6 months warning. They're going to figure out a way to get it done. But if you're like too many of my business owners, they drop off their stuff March 28th. We give it to them April 10th or 14th or 15th, depending on how busy we are and what we're waiting for. Or worse yet, we're doing an extension. And 5 days before the deadline, I tell them, oh, it's due, and by the way, it's going to cost you $20,000 to Uncle Sam. That's just not very smart. So you need to really look at that. So tax planning is one of the very few things where you can actually pay taxes. All right. Now, the biggest confusion I hear, all right, is I commonly hear this is, look, I'm way too busy. I don't worry about tax planning. I hired a good CPA, unquote. And all business owners they have so much on their plate that they're basically taking and they're checking a box. Take care of tax return. Check. Make sure I pay the less. Let's hire a good CPA. Done. And I'm done. It doesn't work that way. All right. When you drop off your tax return, your tax preparer is in tax planning mode, and I can tell you right now whether or not they're doing tax planning or not. Because call up your tax preparer, and if they're not swamped between now and the end of the year, they're not doing tax planning. It's that simple. They're just doing tax preparation. When we're doing tax preparation, all we care about, and this is what we have to care about because the rules are so complicated and because of the time crunch of all the returns we have to do in a very short amount of time, all we care about is getting an accurate tax return that's not likely to be audited. That's what we're trying to do. And to get it up by the deadline, okay? Tax planning is something that takes time, requires me to sit with you, requires you to sit with your tax preparer or tax advisor, go over your particular situation, go over the different options, and then put out a plan for you. All right? So that's the first thing. First thing is they take it seriously. Make sure you read the article because I go into more details on that. Second thing a smart business owner does is they call their tax advisor before they do anything important. All right? I mean, I can't tell you how often this happens. I had a phone call this week from somebody who called me and said their mom sold their property and is now going to give the proceeds to the 4 kids. If they had called me in advance, what I would have told them to do is gift it to the kids. The kids would then be able to sell it and pay no tax because their cost would have been the fair market value at the date of the gift. Instead, they've got about a $400,000 gain. The mom's going to pay about $25,000 in tax for each child. It's probably going to be a tax bill between $80,000 and $100,000. Calling me after you made the sale, all I can do is tell you how much you owe. If you'd called me ahead of time, I would have been able to save them $80,000 to $100,000 on that one phone call. All right. We have another one. The one I use in the article is pretty good because we had a guy who basically trusted his golf buddies. Now, everybody's a tax expert, but the law changes really fast. Golf buddy told him when he was 59 he could take money out without a penalty. Truth of the matter is it's 59 and a half. That, I think he took out 2 or 3 months early. That cost him $5,000. Call your tax preparer. All right. Third thing smart business owners do, they have good accounting records. All right. The IRS's own studies have shown that if you have bad accounting records, you're likely to overpay taxes somewhere between 10 and 30%. Why? You don't know. I mean, the IRS is very simple. When they come in and audit, they take a very simple approach. If you receive the money, they're going to call it income unless you can show them it's not. And if you wrote a check, they're not going to let you deduct it unless you can show why. All right? So two things happen. One, you have a situation where you receive deposits, and if you don't have good records, we go through the bank account just like the IRS, it's income. I had one situation where when I finally asked some questions, we go and look, he had received $80,000 as an inheritance. Well, that's not taxable. To him, he figured he received the money, it was income, so he didn't bother to tell us. All right? But if he'd had good records and it would have said it was an inheritance from his parents, when we were reviewing his records, we would have caught that. All right. The only reason we got it was because he didn't think he did right. He came into us. I started asking questions. All right. Second place, though, is more importantly. That happens, and usually when the income side is off, it tends to be big. The expense side, you don't keep good receipts. You take money out, and you know you spent some of it for business, but you didn't keep the receipts. You don't keep track of it. You don't keep good track of mileage. You don't have the proper documentation for charitable deductions. You don't. Some people come in here and they just have some of the receipts. Income. Remember, the IRS has put in a lot of places to get income. You got W-2s, you got 1099s. You have to report everything, but nobody has to report expenses. That's your responsibility. And if you don't have good accounting records, you're in trouble. Another thing that smart business owners do to reduce their taxes is they get their records to their tax preparer early or late. Let me explain that. And get it to them early because basically if you're going to drop it off on March 31st, before April 15th, that's you and about another 100 or 200 people, and they're all complicated. Or if you're going to wait till October 1st with an October 15th deadline, ain't got time. There's no planning going on, and we're just taking what you give us and put it on the return. We're going to ask some questions, but nobody has time to think, including you, because you're under the gun. You don't have time to go get something, all right? And I said, or late. Look, if you're going to be up against a deadline, you got a complicated return, ask your tax preparer to estimate it. Send in an estimated amount with the extension, and wait till May or June when we're not so crazy to sit down and do it right, all right? I don't mean being late like in November, December, or January after the extension deadline. I'm talking about after March or April, guys, all right? Another thing smart business owners do to save taxes, look, one of the smartest things they do is they pay the tax as they earn it. Now, that doesn't mean sending it to the IRS. It's understanding that you have a partner. We all have a partner, whether we're earning a W-2 or whether we're in business. Uncle Sam's taking their cut. All right? And if you don't believe me, and if you're a W-2 employee, look at your W-2, see the top line, see how little you get. All right? In business, it's the same way, except nobody's taking it out for you. All right? So what you want to do is, now, I understand, many times this is impossible, and we work with them, and that's just life. So if you're in a struggling business, or it's growing, or you had a bad year, well, then you struggle with it. Get with your tax preparer. There's things we can do. But what really is problem is, what I hate to see is somebody that drives up in a brand new Lexus or BMW, or went out and bought, $300,000 vacation home because they had a great year, forgetting that they owe $150,000 to $200,000 to the IRS, and they paid cash for their vacation home. We see it. All right, so make sure you understand that you should be saving the money for it, and better yet, actually making the estimate payments when you should, because the interest rate on that is over 10% right now, right around 10%. Between the penalty for not paying and the interest. Okay, you add the two together, it's right around 10%. If you have a successful business and you're owing that kind of tax, you probably can get a loan a lot less than that. Finally, and probably most importantly, smart business owners get a basic understanding of income tax law. I'm not saying they become tax experts. The last thing in the world I would wish on any of my business owners is they do what I do for a living. All right, you don't want to be a tax expert. All right, but you do need to understand how the game's played. All right, you need to know. You don't even, if you don't even know what you don't know, how can you let the CPA know, hey, I did this, or can I do that? You don't even get to ask intelligent questions. So how do you do this? Well, you get educated. All right. I would get a blog, check the tax blogs. We've been putting it in past issues. All right, just search, and I think I put a couple in this issue too, if I remember right. All right, get some simple books. Write down your questions as they happen and call a CPA, and then check our free webinars. At the end of each webinar, we offer a product that allows you to kind of get a monthly reminder of different ways to cut taxes. And what's kind of cool about that, it's recorded, so you can do like I do. I sit down once every 3 to 6 months on the ones that I belong to and catch up. All right, make sure you take tax planning seriously. Look, we're at the time where in all practicality, every business owner has a choice to make. Are you going to be a smart business owner, or are you going to be one of those that helps pay for Obamacare and all the overspending in Washington? Your choice. Until next time, this is Wayne Belisle, and let's pay the smallest amount of taxes we can. Have a great year.